My name is Bill Gale. I'm a senior fellow in economic studies at the Brookings Institution, and I'm the co-director of the Tax Policy Center. A wealth tax is an annual tax on the amount of assets that people have adjusted for their debt. So for example, it would include a tax on the value of their house, their stocks, their bonds, their businesses, and things like that. The United States does not currently have a national wealth tax. We do have property taxes that apply at the state and local level. One of the ideas behind a wealth tax is that it could limit the power of the wealthy elite in the country. It's clear that policymakers' choices reflect in a disproportionate amount the preferences and interests of the elite and the super wealthy. It's not clear, though, that a wealth tax would reduce their influence all that much. One of the things that people say is that buying political influence is not that expensive. It's measured in tens of thousands or hundreds of thousands of dollars. And if we're talking about people with $100 billion of wealth or $10 billion of wealth, that's almost rounding error. The big administrative issues with the wealth tax is how to value items of wealth like businesses that are not sold on the market. For example, if you have a stock, if you own stock in a company, you can look in the papers and see what the stock is worth. If you have a business that's privately held, there has to be some mechanism for valuing that business in order to assess a wealth tax. There are different opinions about whether a wealth tax would be administrable. Certainly, we could administer a tax on publicly traded assets. It would be harder, but not impossible, to administer the tax on assets that are not bought and sold in markets like businesses. But when we think about whether we can administer the wealth tax, we need to not let perfection be the ideal. The income tax, for example, has about $500 billion every year of tax evasion. 1 out of every $6 that are owed in taxes are not paid. And in addition, there's an enormous industry that's devoted to avoiding income tax. One of the great unknowns about a significant wealth tax is whether the wealthy can avoid the tax on publicly traded assets. For example, Jeff Bezos owns tens of billions of dollars of Amazon stock. It seems like it would be a simple matter to assess, say, a 6% wealth tax on the increase in the value of Amazon stock. The question, though, is what arrangements will tax lawyers come up with that might allow him to avoid that tax? There's been a lot of talk on raising taxes on the rich. Wealth taxes are an obvious way to do that, and they hit the super rich as they've been proposed. There are other proposals as well, such as taxing capital gains more heavily or taxing them as they accrue every year instead of waiting until a person sells the assets, which is how the current system works. Taxing capital gains at death is another option. Under the current system, if someone holds an asset until they die, they never pay taxes on the capital gain on that asset. So raising the income tax rate for high-income households is another option as well. And I think it's important from a policy perspective to think of these not as either-or options, but rather as to think about the combination of options that works the best. For example, if you tax capital gains on accrual, then you can raise the tax rate on capital gains without worrying that people would avoid paying the tax. In the current system, where they only pay the tax if they sell, it's hard to raise the rate because then that would stop people from selling. I think the biggest concern with a new wealth tax is that the rate might be too high. 6% wealth tax, for example, is the equivalent of 100% income tax if the rate of return is 6%. There seems to be this race to the top in terms of wealth tax rates. And I think if we do want to consider a wealth tax on the super wealthy, we should be cautionary about how high that rate goes.